Most retirees hear IRS and home taxes, and they think, okay, that's for rich people, that's for landlords, that's not me. But in 2026, a quiet shift can hit regular seniors the hardest because it changes what you can claim, what you can't, and what you might lose just because you waited a little too long or did one normal thing like sell, move, or remodel. And I'm saying this carefully because I don't want to scare you, but I do want you alert because the people who get hurt the most are the ones who say, I'll deal with taxes later, and then later shows up as a letter, a missing credit, or a bigger bill than expected. Here's the part that makes people freeze for a second. A lot of seniors are planning home upgrades right now because they want lower electric bills, fewer repairs, and a safer home. New windows, a heat pump, better insulation, maybe solar, and for the last few years, there's been a very popular IRS home energy tax credit that helps pay you back. But most retirees and seniors do not realize this. There's a major cutoff sitting right at the end of 2025 for at least one of these big home-related credits, which means 2026 can feel like the year the help disappears. And a lot of people only find out after they already spent the money. And in a second, I'm going to explain the one mistake that makes this worse and why it's more common in retirement than you think. But before I do, I want you to keep one question in your mind while you listen. What if you do the exact same home upgrade, same contractor, and same receipt, same home, but because it's installed a little too late, you get a smaller credit or no credit at all? That's the kind of rule change that doesn't feel like a rule change until it hits your pocket. Now let me talk to you like a real person, not like some tax robot. If you're retired, your home is not just a home. It's your safety, it's your routine, it's where your medication is, it's where your memories are. And for many of you, your home is also your biggest asset. So when the IRS changes something connected to homes, it doesn't feel like tax policy. It feels like stress. It feels like confusion. It feels like, why didn't anybody tell me this sooner? And that's exactly why this video matters, because I'm seeing seniors make plans based on old rules and walking straight into 2026 without realizing the rules don't follow them. Now, I have to be honest with you. People online throw around the phrase new 2026 IRS Home Tax Rule like it's one single line in the tax code. But the truth is, for most retirees, the surprise is not just one thing. It's usually one of two situations. Either you're planning home improvements and expecting a credit, or you're planning to sell, downsize, move closer to family, or move into assisted living and you assume the home sale tax break is automatic. And the confusion is where the money gets lost. So I'm going to walk you through both in plain English, and I'll tell you the exact watch out moments that sneak up on seniors. And yes, stay with me, because there's one part that almost nobody says out loud, and it's the part that causes the biggest, oh no, are you serious? Reaction later. Let's start with the home energy credits, because that's where 2026 is going to sting for a lot of households. The IRS has a page called Home Energy Tax Credits. If you've ever Googled tax credit for windows, tax credit for heat pump, tax credit for insulation, that's where you end up. And right there, the IRS explains how these credits work and the years they apply. Source. And here's the big thing most seniors don't notice. Some of these credits have time windows. They don't last forever. And according to the IRS, one of the big home energy credits isn't allowed after the end of 2025, meaning 2026 is when people start realizing it's gone, after they already planned around it. Source now, let me make this feel real. Imagine you're 68. You're on a fixed income. Your electric bill is getting painful. Your old HVAC system is loud, and you're tired of patching it. A contractor says, if you install this heat pump, you may qualify for a federal tax credit. So you breathe a little easier. You think, okay, that helps. I can do this. Then the project gets delayed. Parts are back ordered. The contractor pushes the install date. Maybe you had a health issue. Maybe you had a family emergency. So the system gets placed in service in 2026 instead of 2025. And suddenly the credit you were counting on isn't there the way you thought it would be. That's not just a small change. That can be the difference between feeling stable and feeling like you made a huge mistake. And the reason this hits retirees harder is simple. You don't have extra years of salary to make up for it. When you're working, you can sometimes recover from a surprise cost. In retirement, a surprise cost can sit in your stomach for months. Now, I'm not telling you not to improve your home. I'm telling you that 2026 is a year where timing matters more than most people realize. And here's the open loop I promised you. There's one specific misunderstanding seniors have about tax credits that makes them think they'll get the money back no matter what. And it's not true. But I'm going to hold that for a little later because you need to understand something else first. You need to understand the difference between a credit and a deduction because this is where people get quietly hurt. A tax credit is like a coupon against your tax bill. A deduction is like lowering the amount of income the IRS taxes. Those are not the same thing. And the reason I'm telling you this is because a lot of retirees say, I don't owe much tax, so a credit doesn't help me. Sometimes that's true, sometimes it isn't. It depends on the type of credit, your tax situation, and the rules for that year. And seniors get confused because their taxes change after retirement. Maybe you used to itemize. Now you take the standard deduction. Maybe your income is a mix of Social Security, a pension, and IRA withdrawals. Maybe you had a big medical expense year. Maybe you didn't. So when a home tax credit changes in 2026, it doesn't hit everyone the same. But here's the dangerous part. A lot of seniors assume if I qualify, the IRS will just figure it out. No, that's not how it works. If you don't claim it correctly, you can lose it, even if you were eligible. And if you claim it wrong, you can trigger letters, delays, or audits that you do not have the energy for. Now let's shift to the second big home tax rule area that can blindside seniors in 2026: selling your home. I want you to picture the most common retirement plan in America. You sell the family home, you downsize, you move to a smaller place, or you move to a different state to be near family, or you move into a retirement community, and you're thinking, it's fine. I heard you don't pay taxes on the first $250,000 or $500,000 when you sell your main home. That idea comes from a real IRS rule. It's the home sale exclusion, often called the Section 121 exclusion, and the IRS explains it in topic number 701, Sale of Your Home. Source. And yes, the IRS says you may be able to exclude up to $250,000 of gain if you're single, or $500,000 if you're married filing jointly, if you qualify. Source. But seniors get burned because they don't realize it's not automatic. There are tests, timing rules, and reporting rules. And in retirement, people's living situations get complicated. Maybe you moved out for medical care. Maybe your spouse passed away and you kept the house but didn't live in it the same way. Maybe you rented it for a year while you tested a new location. Maybe you added someone to the deed. Maybe you put the home in a trust. Maybe you lived with your daughter for 2 years and then sold the home later. All of those life changes can collide with IRS rules, and that's why seniors feel blindsided, because they weren't trying to work the system. They were just living life. The IRS points many people to Publication 523, Selling Your Home, which goes deeper into how the rule works. Source. And here's the emotional part. A lot of retirees think selling the home will free them, financially and emotionally. But if the sale creates taxable gain you weren't expecting, it can feel like the home you worked your whole life for is now creating a tax problem at the worst time. And yes, I'm going to say something that's uncomfortable. Some seniors avoid selling for years because they're scared of taxes. And that fear makes them stuck in a home that's too big, too expensive, or not safe anymore. So you see the trap? You wait because you're worried, but the waiting itself can create a worse outcome depending on your situation. Now let's talk about the new 2026 twist that people aren't connecting. In 2026, a lot of home-related tax conversations will overlap. Home energy credits changing, inflation adjustments changing, retirement tax changes changing, planning decisions happening. And seniors will hear new rules and their brain goes, I can't keep up. That's why you need one simple approach. Ask the right questions before you spend and before you sell. Because the IRS doesn't care that you're tired. They care what's on the forms. And if a home sale is reportable, the IRS points to Schedule D and Form 8949 in some situations. Source and Form 8949 is literally for reporting sales and dispositions of capital assets, with totals carried to Schedule D. Source now, don't panic. I'm not saying you personally will need those forms. Many home sales don't require reporting if the entire gain is excluded and you meet the rules. I'm saying you don't want to assume, because assumptions are where seniors get hurt. Now let me bring back that open loop. The misunderstanding about credits. Here it is. A lot of people hear tax credit and think it means the government will send me a check. But many credits don't work like that. Some credits reduce your tax bill, but if your tax bill is already low, the value of that credit might not feel like what you expected. So when a senior says, I'm going to spend $18,000 on a home upgrade because I'll get a big credit back, that can be a dangerous sentence if nobody checks the details first. That's why I always tell retirees, before you sign anything, ask, is this credit refundable or non-refundable, and what year does it apply? And if the contractor can't answer that, that's normal. Contractors are not tax professionals, but you need someone to answer it before you spend. Because in 2026, missing a deadline or misunderstanding a rule is not just paperwork, it's grocery money, it's medication money, it's peace of mind. Now let me slow down and talk directly to you. If you're watching this and thinking, okay, I'm overwhelmed already, I get it. So here's the simplest way to think about this new 2026 IRS Home Tax Rule issue. In 2026, the IRS home-related rules that most often surprise seniors show up in three moments. The moment you install something expensive on your home, the moment you sell the home, the moment you move out and the home changes how it's used. And that third one is the quiet one, because you might not sell for years, but moving out can change the story of the home. If you stop living there as your main home and it becomes a second home or a rental or just sits empty, your future tax situation can shift. And that's why retirees who temporarily move in with family sometimes get surprised later when they finally sell, because what felt temporary to you can matter to the IRS. Now, I want to insert something natural here, because I know people watching this channel want simple updates like this. Which state are you watching from? Tell me in the comments. And if this is helping you understand the changes without all the scary jargon, leave a like so more seniors actually see it. And for clear and simple USA retirement and IRS updates, subscribe to the channel because I keep these videos human and practical. Now let's get even more practical. Let me give you two quick, realistic stories. Not perfect stories, real-life messy stories. Story 1. A retired couple in their early 70s. They live in a home they bought decades ago. Their home value went up a lot. They want to sell and move closer to their grandkids. They heard about the $500,000 exclusion. They think, we're safe. But then a surprise appears. They did a cash-out refinance years ago, and they're confused about basis. They did major remodeling but don't have receipts. They also rented the home for a short time when one spouse had to relocate for medical treatment. Now they're not sure what counts, what doesn't, what needs to be reported, and they're scared they'll do it wrong. That's when Publication 523 becomes your friend, because it's the IRS guide that explains the rules and worksheets for selling a home. Source. But most seniors don't read it until after they sold, and when you read it after the sale, you're already under pressure. Story 2. A single retiree, 66 years old. She's trying to lower her monthly bills. She upgrades insulation and replaces windows. She's counting on a federal tax credit. But the project gets delayed into 2026. And then she hears, that credit ended, or that part changed, and she feels tricked. And here's what I want you to hear. It's not that you were stupid. It's that the rules have dates and normal life causes delays. And the IRS itself is very clear that these home energy credits have specific year rules, and you should confirm what applies for your tax year. Source now, let's pull this together in a way you can actually use. If you're a senior planning any of these three things, home upgrades, downsizing, or moving, 2026 is a year to slow down and double check. Not because you're doing something wrong, but because the cost of being slightly wrong is too high now. And I also want to protect you from scammers. Whenever big IRS changes float around, scammers start calling seniors saying, "You qualify for a new credit," or "You owe a new fee," or "We can get you a bigger refund." No, please don't do that. If you ever need to verify home energy credits, start at the IRS official page, Source. If you need to verify home sale rules, start at the IRS Topic 701 page, Source. And if you're selling a home and you need the deeper details, look at Publication 523. Source. Now, I told you I'd keep this conversational, so let me say what a lot of seniors are thinking but don't say out loud. You're tired of learning new rules. You did your part. You paid into the system. You kept records. You raised kids. You worked. And now you just want things to be simple. And it feels unfair when a rule changes and suddenly you're expected to keep up like you're a CPA. I get that. I really do. So here's the most human advice I can give you. Don't try to memorize everything. Just remember the danger zones. Anytime you hear deadline, anytime you hear placed in service, anytime you hear primary residence, anytime you hear 2 out of 5 years, anytime you hear credit ends this year, those phrases are like flashing lights in retirement planning because they affect whether you keep money you thought was yours. Now, I want to talk about one more thing that seniors overlook: paperwork. This is the boring part, but it's also the money part. When it comes to credits and exclusions, proof matters. Receipts, contracts, dates, what was installed and when, what it cost, what was paid, when you moved in and when you moved out. And I know, your first instinct is, I don't want to deal with that. But listen to me carefully. If you don't save simple proof now, you might pay for it later with stress, tax bills, or lost credits. And that stress is not worth it. Now, I also promised internal linking for an upcoming video. So here it is, naturally. I'm preparing a full breakdown on what people and updates will look like in 2026, and you'll see that video right after this on your end screen. Now, let me end this in a way that keeps you safe, not scared. If you're a retiree or senior, you don't need to panic about 2026, but you do need to stop assuming the old rules will automatically protect you. Because the most painful moment is when you already made the decision, already signed, already installed, already sold, and then you find out the rule changed, expired, or didn't work the way you thought. So here's my final question for you, and I want you to really think about it. If you had to make one big home decision in the next 12 months, sell, downsize, remodel, or move, what's the one detail you're most worried the IRS could use against you? Because what happens if your IRS record shows a home decision you forgot about and it changes what you owe in 2026?